Welcome to the deep dive. Today we're digging into Shriram Finance, SFL. We're looking at this idea called the butterfly transformation. Basically, is there a big re-rating chance the market's missing? Let's get to the chase. The source material straight up calls SFL a BUY. They've put a 3-year price target of INR 920 on it, all based on what they see as a fundamental valuation anomaly.
Yeah, and the anomaly is pretty straightforward when you break it down. The market seems stuck, pricing SFL like it's still the old Shriram Transport Finance, STFC, highly cyclical. But the reality, especially after that big 2022 merger with Shriram City Union Finance, well, the company's really changed. It's morphed, you could say, into something much less cyclical, more profitable, growing faster. The balance sheet looks different.
Right, the stock price hasn't caught up yet.
Exactly.
Okay, so let's talk about this caterpillar to butterfly idea. Before 2022, STFC was, everyone knew it as the truck driver's bank, right? Super dominant in its niche. But commercial vehicle loans, the CV stuff, was like 75% of their whole book.
Yeah, which meant its fortunes were tied directly to the freight cycle.
Yeah.
Very volatile. The merger with SCUF, that was the key move. The strategic detoxification, some call it, because SCUF brought in totally different products, high margin, fast-growing things like MSME loans, gold loans, two-wheeler finance, stuff that isn't tied to that CV cycle. And the immediate impact, that CV exposure number dropped instantly, down to about 46%.
Okay, 46%. That's a much healthier, more balanced mix. Big shift in risk. But does it actually show up in the numbers? Like, is the new combined company genuinely better? Where's the proof?
Oh, yeah, it shows. Look at the net interest margin, the NI. That's their core profit from lending. Pre-merger, it was around 6.6%. Post-merger, it's jumped to 8.8%.
Wow, okay. Significant jump.
And look at the return on equity, pre-tax ROE. That shows how well they're using shareholder money. That's climbed from about 15% to a solid 21%. So yes, it's quantifiably more profitable, more stable now.
Now, the moat here is interesting. The analysis says it's not some fancy tech. It's this 45-year history, this kind of phygital model, physical presence, plus digital, based on trust, with the informal, unbanked economy.
Precisely. It's all about human relationships.
Yeah.
Local knowledge for underwriting. Stuff that formal banks, fintechs,
Yeah.
they just can't replicate easily with credit scores. They don't have that local trust network.
Right.
And that moat plugs right into a massive opportunity, the MSME credit gap. It's huge. It's like a $5.7 trillion underserved market globally.
Yeah.
SFL's smart move is cross-selling. They've got this massive customer base, over 9.7 million people. They leverage that base to push these other high-yield products gold, personal loans, with almost zero extra cost to acquire the customer. That really juices profitability.
Okay, but that trust model, lending to maybe higher risk segments, it sounds like it needs careful handling. The source's mission, this plant versus weed management philosophy, how does that play in?
Yeah, it reflects their conservative style. They tend to guide cautiously, underpromise a bit, like their AUM growth forecast is 15, 17%. But they often beat their own guidance on growth and credit costs. It builds confidence, especially when they project earnings growth around 16, 18%.
Okay, so that conservatism combined with the improved metrics, that brings us back to the valuation gap.
Exactly. SFL trades at a PE ratio of, around 14.3 times earnings.
Yeah.
Meanwhile, you look at peers perceived as high growth, high quality, like Bajaj Finance or Chola.
Yeah.
They're trading at PEs well over 30.
That's a massive difference. So that's the re-rating potential right there.
It's the core of the opportunity, yes.
But let's play devil's advocate. The gross stage 3 loans, the bad loans or GNPA, it's still kind of high, right? 5.32% as of September. And they don't have those cheap KSA deposits banks get. Their funding must be more expensive. Isn't that a big risk? How does that square with the 920 target?
That's the main counterpoint, absolutely. The customer base is higher risk, and a sharp economic downturn could definitely hurt them disproportionately. That GNPA number reflects it. And yes, their cost of funds is structurally higher than banks. That's a disadvantage. But the bet is twofold. One, the high yields on their loans offset the higher funding cost, keeping them very profitable. Two, as the portfolio mix shifts more towards the non-cyclical high-yield MSME and gold segments, that should dilute the overall risk from the older CV book over time. The thesis is that this improving quality will eventually force the market to give it a higher multiple. That's the re-rating story.
Okay, so summing it up for you listening. The forecast is for profit after tax, PAK, to grow at a compound rate of maybe 16 to 18% a year for the next 5 years. The investment idea here isn't just about that growth. It's really about capturing this potential re-rating over the next, say, 3 to 5 years as the market hopefully catches on.
Yeah, which means, look, this probably isn't a stock you just buy and forget about. It demands some patience, and you have to be comfortable with the higher risk nature of lending to that informal segment. But if you are a patient value-focused investor looking for exposure to India's growth.
Yeah.
It's a pretty unique setup.
So the final thought then, your potential return here seems to come from two places. You've got with the 16, 18% earnings growth itself, plus potentially a big kicker from that valuation multiple expanding if the market view changes. The big question is, will the market actually see the butterfly emerge before that re-rating opportunity narrows?